I think the fears here are going to shift from rising interest rates and higher inflation potentially to recession, especially, and you've heard me on this before, because we see inventories piling up throughout the ecosystem. So innovation stocks in the public equity markets are down, I'm going to say broadly, 50 to 75% in the last year. That's as bad as it got during 0809.
Hey guys, welcome back to Library of Wealth. Today we have the CEO of Ark Invest, Cathie Wood, with her strategy for success in an inflationary market, as well as what she sees coming for the next few months. Cathie observes that volatility has become the watchword in the industry, as most people now associate it with risk and uncertainty. When time horizons collapse, volatility increases. Wood has begun using volatility to her advantage, focusing all of her concentration on the highest conviction names. Wood stresses the importance of keeping a 5-year investment time horizon because in that time frame, there's an enormous difference between linear and exponential growth. She believes that Wright's law is the right answer in terms of exponential growth trajectories, and that the surprises along the way will be huge. Cathie sees that in the next 5 years, the market will be tough, but it's certain that the exponential growth trajectories have been accelerated by the turmoil in the labor market's logistics. Let's listen to Cathie Wood as she gives her opinion on today's market conditions and what's to come. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
And I do want to talk a little bit about volatility here. Volatility has become the watchword. And as Brett said in his opening remarks, many people associate volatility with risk. Volatility is more associated with uncertainty. And when time horizons collapse, as they have within the last year, then the volatility does increase. We use volatility to our advantage. We concentrate towards our highest conviction names, and that tends to work out very well as we go through these corrections. And that I hope our research today telegraphed to you. It's also very important to keep that 5-year investment time horizon. The difference between linear growth and exponential growth when you're talking about a 5-year period is enormous. And because Wright's law gets us to, I think, to the right answer in terms of the exponential growth trajectories, the surprises are going to be enormous. And most important, we like to say, as we're focusing on the 5 years, keep your eye on the prize. We realize it's been a very difficult market. We also do believe, and our conviction this past year actually has increased, that these exponential growth trajectories have been accelerated by, and even more so now, by the turmoil we're seeing in the labor markets, logistics, and in the financial markets.
Wood expands on Raoul Pal's take on the rapid evolution of innovation, but Cathie has also seen that in the public equity markets, it's been completely devastated in the past year as well. She also notes that last year, people thought that the economy and interest rates would go up, and even though inflation would rise, it would eventually be tamed. Instead, the supply chain issues didn't go away, and the fear of inflation and interest rates that had at first only begun to affect the market as a whole. Wood has noticed the 2-year Treasury and market is priced in at least 4 interest rate hikes.
And then reflecting on Raoul Pal about blockchain, just innovation is evolving so quickly. We have to just listen and look at the tone changes that take place from one conversation to the next to understand how rapidly the world is going to change. But Raoul said something I thought very important, and it does address an elephant in the room. We know that innovation in the equity markets, the public equity markets, not the private equity markets, has been ravaged in the last year. It's about a year that it has been ravaged. And Raoul mentioned that when there is a change in expectations, and last year the thought that the economy would open up and interest rates would go up, inflation would go up but would be tamed. During the year, there was a change. The supply chain issues did not go away. And so this fear about what inflation and interest rates are going to do has gripped the market. First, it gripped the innovation space almost exclusively in a puzzling way. Now it seems to be affecting the market a little more broadly. But I will say now that the 2-year Treasury and the market itself has priced in at least 4 interest rate hikes, that this possibility is priced in the equity markets too, increasingly. And if anything, oil prices going up are an incredibly burdensome tax on the lowest socioeconomic demographic sectors in our economy. Now, in the private markets, of course, we're seeing one example after another where the pricing is up in the last year. We're seeing up 50 to 100%. And I think the private markets do have it more, they're more correct in terms of what they should be discounting right now because of what you heard today about research, how profound the changes are, how exponential the growth will be, and how the equity market cap is going to explode in these areas. We really do believe that will be the case. Now, besides interest rates and inflation, there's been a double whammy in the public equity markets, and I think this is what helps explain what's going on. The move to risk off for many traditional asset managers means get back to your benchmarks. And if you look at the broad-based benchmarks, even the broad-based tech benchmarks or tech-oriented benchmarks, you're going to see that they are short innovation, true innovation. They're mostly in that the innovation that they're capturing is mostly in the mega cap tech stocks. They've become a disproportionate weight in many indices, and I would submit in many assets, portfolios in the traditional asset management world. This move to benchmark style investing, we believe, has been turbocharged during the last 20 years by the tech and telecom bust first, and then the 08-09 meltdown. And the risk aversion in the markets is palpable. And so going back to benchmarks or repositioning portfolios so that they are closer to their benchmarks seems to be what has been going on. What happens then? Well, they're selling the real innovation stocks out there, the emerging innovation stocks, and those that are going to create the outcomes that we showed you in our research today. Traditional research is becoming very benchmark sensitive as well. It's not just the portfolio managers, it's their analysts. And they have also become very short term in their time horizons. There are two other characterizations of traditional research out there that Ark has actually tried to capitalize on in terms of inefficiencies in the marketplace. The coverage in the traditional asset management world of analysts is broken down primarily by sector or industry or sub-industry. Very specialized, very narrow, and as I mentioned before, typically very short term. And because of the siloization, their ability to understand the convergences that are taking place between and among the 14 technologies that we touched on today, they're not able to see them as clearly as we are. We are looking for them.
Cathie believes in the research showing how profound changes are, how immense exponential growth will be, and how the equity market cap will explode in these areas. Wood continues by saying the move to risk off for most traditional asset managers means getting back to their benchmarks. And when looking at all broad-based benchmarks, there is no true innovation, and what innovation is being seen is mostly captured in mega cap tech stocks. This has become a very disproportionate weight in numerous indices. The style of benchmark investing in traditional asset management has been supercharged during the past 20 years by first tech and telecom, then by the 08-09 meltdown. Wood says that research is becoming very benchmark sensitive, and portfolio managers and analysts are becoming short-term in their time horizons. The coverage in the traditional asset management world is very specialized, as it is broken down by industry, sector, and subsector, which, because of siloization, their ability to understand the convergences between the 14 technologies is inferior to Wood's team. What do you guys think about Cathie Wood's opinion on the style of benchmark investing that is now common in traditional asset management today? Let us know in the comments below. Guys, thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.